Hello, welcome to the latest corporate video of Bengal Energy. My name is Chayan Chakrabarty, President CEO of the company. Joining me in sharing the delivery of this presentation to you are Richard Edgar, our Exec Vice President, Jared Blanchard, our Chief Financial Officer, and Kai Eberspacher, our Australia Country Manager. Before proceeding forward with the presentation, I'll point you to our cautionary and forward-looking statements and oil and gas advisories to be presented at the end of this video and included on slides 31 and 32 of the accompanying corporate presentation report. I'd like to invite you to review them. The presentation is divided into 5 sections. Some of you may have reviewed it in our website already. In these sections, we'll outline the key summary attributes of our company, the areas from where we expect our near-term and medium-term growth, highlight the operations that are expected to underpin this growth, and we'll wrap all this up to summarize for you why you should own Bengal Energy stock today. In the appendix to the accompanying corporate presentation report, we provide information including a summary of our experience in the oil and gas space in Australia, executive team and board bios, details on our assets, net asset value calculation, and other details. Bengal Energy is a Toronto Stock Exchange listed oil and gas exploration and production company with assets in Australia. We are looking to seek a dual listing on the Australian Securities Exchange within the next 12 months. I'd like to speak on this slide to 4 key features of our company. First, the company's 492,000 net acres of production, development, and exploration assets are located in the eminently stable and business-friendly royalty tax jurisdiction of Australia, where all our onshore assets are located in the great state of Queensland. There, we receive world-class commodity prices, oil at a premium to Brent, and natural gas expected in the range of 7 to 9 Australian dollars per MCF. Second, the company today has a balanced mix of transformational assets that can provide near-term growth and longer-term upside. This growth potential is on top of a stable production base from an ultralight oil asset yielding over 38 Australian dollars per barrel netback at $60 US Brent oil price. Note that our corporate reserves values are evaluated independently by Calgary's GLG Limited, and the most recent reserves update evaluated our working interest before tax PV10 reserves value at 96 million Canadian dollars on a proved plus probable basis and 36 million Canadian dollars on a proved basis. This reserves report is from March 31st, 2020 fiscal year end, with the current fiscal year end independent reserves report expected to be finalized by mid-June of this year. Third, our market cap is approximately 35 million Canadian, with that is zero debt, 4 million Canadian cash, and positive operating cash flow. Our share price has been trading at a significant discount to our net asset values based on the previously stated reserves values, and we believe that this newfound strength in our balance sheet has primed the company to both achieve that value and meet our growth targets, noting that our reserves value excludes any estimated future cash flows from our robust portfolio of development and exploration assets. Fourth, the company's executive team and board have substantial Canadian and international oil and gas technical, operational, commercial, business, and investing experience, and many years of experience producing and exploring for commercial hydrocarbons in Australia specifically.
Today, the company has over 490,000 net acres of transformational assets targeting near-term growth and long-term commercial upside. We are excited to commence work on a balanced portfolio of projects immediately. These projects have been de-risked by previous activities including long-term production, successful post-drill testing, and wireline logging, resulting in identified hydrocarbon pay zones. All of these activities indicate significant economic potential to add production and reserves to the company. Now let's look at each of these assets individually. The Warina field was a successful natural gas producer tied into a 26-kilometer pipeline connected to a gathering station. We own 100% of the wells and pipeline infrastructure in this field. Our immediate focus will be to recommission the pipeline and restart production after working over the suspended wells. The wells produced up to 10 million standard cubic feet per day before they started to water out against the high back pressure. In 2019, Santos installed a compression station at our tie-in point in Coonabarry, which now affords us a much larger operating envelope for production. Therefore, Warina has the potential to immediately and positively contribute to the cash flow upon startup. On Ramses, where we have a Permian gas discovery, our immediate focus will be on a discovered and tested oil zone in the shallower Jurassic Pulawana formation. Here, we will work over one well and construct fit-for-purpose crude oil storage and loadout facilities to commence production. We are encouraged by the test results from the identified oil zone, which may be indicative of a de-risk addition that could meaningfully impact the company's oil production. On Gina, we will complete an existing suspended well where a gas discovery was made in the Permian. We will then proceed with testing the zone of interest to determine its deliverability. The well will be suspended ready for connection in concert with a future drilling campaign and ongoing exploration by others in this area. Depending on the success of the adjacent exploration drilling campaign, Gina's gas export would be well on track to go south into the existing gas pipeline infrastructure. One of our most exciting events this year will be the drilling of the Legbar well in the farm-out portion of ATP 934. The farm-out portion is the southern area of the ATP tenure block comprising over 100,000 acres. Drilling there could commence as early as August this year. ATP 934 in total gives us access to over 178,000 acres of wet gas fairway opportunities. Legbar will be the company's first exploration well targeting the high-impact, liquids-rich natural gas play in the Cooper Basin. This area has recently become increasingly prolific following exploration successes by both Beach Energy and Santos directly offsetting our targets. The commercial aspects of the farm-out deal include a 100% carry of the drilling cost for Legbar by Santos to earn a 60% interest and become the operator of this portion of the block. At Cuisinier, we continue to focus on low-risk development projects to enhance recovery and increase production, with higher impact activities expected to commence in the longer term, as we will discuss shortly. In our 100% owned Karnak field, we plan to twin an existing well that showed a significant gas pay zone in the Permian. We believe that with the advance and application of underbalanced drilling techniques in the Cooper Basin, the new well will be successful in connecting the behind-pipe gas resources to existing infrastructure in close proximity. Karnak, therefore, is well positioned to contribute to near-term cash flow generation.
This table outlines the capital expenditures associated with the company's near-term growth assets, which are management's best estimates over the 12-month period from early Q3 2021. All projects are expected to add additional recoverable hydrocarbons on success that would add to the company's base production and cash flow, and will also provide the basis for continued growth through these and other organic assets in our portfolio. As we will outline through this presentation, each of these projects carry the potential to immediately and drastically increase production, define parameters for transformational further development, or both. Note that the Legbar capital is our best estimate for a flow line assuming drilling success. Gina, upon success, would see production in the future through existing or new natural gas infrastructure. As we discussed earlier, our net asset values, which are already at a significant premium to current market valuations, do not include any potential value adds from any of these near-term projects outside of Cuisinier.
We have just summarized our balanced selection of near-term growth projects that will form a solid platform to support our ambitious long-term growth plan. These near-term steps strengthen our production, reserves, and cash flow base, while offering our shareholders access to potentially transformative exploration acreage. Contingent on Legbar's success, we expect to see additional exploration and appraisal activities, followed by a potentially large-scale development program on the 103,000-acre southern ATP 934 block. In addition, we have identified 4 high-graded Permian exploration prospects on our 100% working interest, 75,400-acre northern ATP 934 block that we will want to evaluate through a combination of drilling and 3D seismic. These prospects are all defined by reprocessed 2D seismic and exhibit structural closure and other characteristics similar to the seismic expression seen over the surrounding natural gas discoveries. A success on any one of these features can be quickly brought to market through a connection to our 100% owned pipeline connecting to the Coonaberry transfer point. On Cuisinart, our longer-term plan is to continue reservoir management activities to enhance recovery through an expansion of water flood incrementally across the field based on the success of the current initial phase of the water flood project. We expect this to also have a positive impact on further development drilling. Also on Cuisinart permit, we are excited about the drilling of the potentially high-impact Chef 1 exploration well. On Karnak, Ramses, and Gina, an early commercial success will imply an expanded development program and improved resource management. Finally, we also anticipate the exciting commencement of the next phase of activities on our 10% working interest ACRL 10 offshore Katandra. More on that on a later slide.
We are excited to culminate over 5 years of focused efforts surrounding ATP 934, where we have consolidated our working interest to 100%, acquired complementary 100% operated assets, and then farmed out a portion of the block to the basin-leading gas explorer. In addition, we recently received regulatory approval for a renewal and extension of ATP 934 for a further 6 years. We have discussed the various development projects that drive our enthusiasm for the next 12 months, and it's important to consider these opportunities in the context of their substantial commercial potential. In the Cooper Basin, the economics associated with liquids-rich gas discoveries remain attractive and stable. Demand for natural gas is supported by local and LNG export markets, driving average annual prices between $5 to $9 Australian per MCF, as quoted by the Australian Energy Market Operator over the last 5 years. As you can see from the map, the permit and recently acquired PLs are in the right location, surrounded by and on trend with recent gas discoveries and nearby to existing gathering infrastructure. This lends credibility to our prospects and ensures immediate commerciality on successful development and exploration programs through connection to existing and undercapacity gas and liquids transmission infrastructure at the nearby Coonaberry and Tartula offtake points. These provide various sales options and connectivity to existing pipeline infrastructure.
Bengal was fortunate to be approached by Santos to farm in on a portion of our ATP 934 block. This farm out finances and de-risks the initial field exploration by the basin-leading gas explorer, with whom Bengal already has an existing and successful partnership at the Cuisinart field. Additionally, and of equal importance, we are encouraged by the interest in our land given Santos's recent high-impact success in neighboring fields. According to recent publications from Beach Energy, who partner with Santos in the fields immediately south and west of ATP 934, their 2020 program achieved 100% exploration success over a 9-well campaign that resulted in flow rates between 6 to 13 million cubic feet per day per well based on initial production. Santos will carry the drilling costs of one well in the second half of 2021 to earn a 60% operated interest in the ATP 934 Southern Farm-Out block as shown on the map. If successful, Bengal would be more than excited for the opportunity to participate in any large-scale development program led by Santos to follow up on their success of their recent exploration activities.
This map highlights some of the recent analogous success as well as the targets we've identified on our southern farm-out block and our 100% working interest block. All of these prospects shown in red on the map are structural closures mapped from 2D seismic. Many of these features have similar characteristics to the known gas at our nearby Guinea petroleum lease, or PL, as well as the producing Bantam well to the south. If the Legbar well, scheduled for later this year, produces at the levels of the wells in the block to the south, a single success here could more than triple our BOE equivalent current production. Our 100% exploration program, including a combination of 3D seismic and drilling, would follow up on any success from the Legbar exploration well and help to define the prospectivity of the field. With over 100,000 acres of highly prospective exploration land, already high-graded by existing 2D reprocessed seismic and regional exploration success, the block has the potential to underpin our long-term growth plans over the next 2 to 5 years.
Over the past few years, the Cuisinart field has provided a stable and profitable production base while remaining underexploited relative to its vast proven and probable reserves. As we have discussed earlier, production from this field demands a premium to Brent benchmark pricing and results in an operating netback of more than 38 Australian dollars per barrel at US $60 Brent price. Because of this, we are eagerly anticipating the results of our recent water injection pilot project on the Cuisinart 24 well. This program would increase overall crude production in 4 offsetting wells and also reduce water handling charges, further improving our field economics. More importantly, an effective pilot will support a field-wide reservoir management program and more commercially efficient development drilling to effectively exploit the field. The ultra-low viscosity of the Cuisinart crude oil in reservoir conditions, the very low solution gas-oil ratio, and the overall field permeability all add up to a field-wide water flood in this field being an efficient and effective recovery scheme. In addition to this, the joint venture will continue its successful vertical frac program. Over the past 4 years, 9 wells have been fracture stimulated with the results showing an increase from average of 221 barrels per day to post-frac rate of 788 barrels per day. Specific well locations and timing will be finalized once the water injection pilot has been evaluated.
Over and above the Cuisinart development opportunities, we are most excited by the 3D controlled Chef exploration well prospect. This will be the first well in this part of the Cuisinart field area to target the prolific Jurassic Age reservoirs of the Birkhead-Hutton formations. These zones produce in the offsetting Cochinero and Cook oil fields. We are encouraged by the initial productivity of wells in these pools. The Chef well has ranked high in the operator's basin exploration portfolio, which confirmed the de-risked nature due to its location between analogous targets in Cook and Cochinero. This slide speaks to the long reserves life of the Cuisinart pool and its consistent production and decline profile. The value here can be maximized with efficient development, including a field-wide expansion of waterflood secondary recovery and development drilling, which may include the use of horizontal technology over time to continue the effective exploration of the producing field.
The first Katandra well was drilled in 2004 and discovered an oil pool on the south flank of the Tancred Horst in the Timor Sea. Recent discoveries along trend have created renewed interest in the area, and our recent work is focused on state-of-the-art 3D seismic reprocessing. The new interpretation supports the prospect of significant unproduced attic oil within our block updip from the original oil discovery at Katandra. Management is excited about the operator's assessment of potential recoverable oil, which supports further investment. For your information, historic oil fields along trend show cumulative production of 112 million barrels from the Jabiru pool and 59 million barrels from the Chalice pool. Well costs estimated at $10 million, which is net $1 million to the company's 10% interest. Based on the operator's updated interpretations and given the significant size of the proven producing oil fields in the area, management finds the upside opportunity in this block to be an exciting candidate for investment by the company. Success here would be transformational through the impact on reserves as well as production levels through the drilling of multiple development wells in this world-class basin with well-capitalized partners.
Bengal Energy offers a unique combination of high potential impact development and exploration exposure in a stable, high netback jurisdiction, along with a stable production base and a cash flow stream that is expected to grow substantially. The company's assets and strategy are very well positioned to provide a strong return to our shareholders. To summarize what we have outlined for you in prior slides, there are 4 major reasons to own Bengal Energy today. First, the company is in the right world-class hydrocarbon province. Our 492,000 net acres of assets are located primarily in Queensland, where we receive world-class crude oil and natural gas prices. The fiscal regime is stable and the terms economically attractive. Second, the company today has the right growth potential due to a balanced mix of transformational assets that can provide near-term growth and longer-term upside to our company's shareholders. Third, we have the right balance sheet. Our market cap is approximately 35 million Canadian with no debt, 4 million Canadian cash, and positive operating cash flow, all of which support our immediate growth priorities and activities. Fourth, the company's executive team and board have the right skill set, combined with many years of experience producing and exploring for commercial hydrocarbons in Australia specifically. That concludes our presentation. Please take a moment to review the material in the appendix on slides 23 and onwards. Thank you for your time and for your interest in Bengal Energy.